Build your dreams, live rich, and leave
Hello
rich.
and welcome. I'm Krish. Here, we believe that living rich isn't about being lavish. It's about living peacefully, completely free from financial anxiety. Now, just a quick heads up, everything we talk about today is for your education. When it comes to your own money, please talk to a CBI registered advisor to build a plan that's perfect for you. All right, let's jump right in. This one sentence, this is probably the single most common thing I hear from people in India about insurance. And look, on the surface, it makes sense, right? You think, hey, if I'm paying all this money for years and thankfully nothing happens to me, shouldn't I get it back? Why should it just be a waste? Well, today we are going to take that exact idea and we're going to tear it down. I'm going to show you precisely why wanting your money back from insurance is a financial trap, and how a policy that gives you absolutely zero back if you survive, what we call term insurance, is actually the smartest, most powerful financial decision you will ever make for your family. So let's break it down. On one side, you've got these money back or endowment plans. Now, the problem is they try to mix two completely different things, insurance and investment. And you know what happens when you mix things? You usually get a pretty mediocre version of both. So with these plans, you get really low insurance cover, maybe 5, 10 lakh rupees, and at the same time, you get really low returns, maybe 5 to 6%, which in a country like ours barely even beats inflation. Your money isn't really growing. But then, on the other side, you have a pure term plan. Its only job, its one job, is protection. That's it. No returns if you make it do the term. But for the same amount of money, or often even less, you get massive coverage. We're talking 1 crore, 2 crores, or even more. So really, the choice is simple. Do you want the worst of both worlds, or the absolute best of one world that truly matters? I want you to burn this sentence into your mind. This is the foundation for every smart financial decision. Say it with me. Insurance is not an investment. It's a cost. It's an expense, just like your electricity bill or your internet bill. I mean, think about it. You don't expect your electricity bill to give you a return, do you? No, you pay it for a service, the service of having light. In the exact same way, you pay an insurance premium for the service of having peace of mind. Investment, that's a different game entirely. That's for building wealth. That's what your mutual funds and stocks are for. Insurance is what you buy to protect all of that, to protect your family from total financial disaster. Never, ever mix the two. Okay, so if insurance is just a cost for protection, then what exactly are we protecting? A car? A house? Nope. We are protecting something so much more valuable, something that we almost always forget to put a price on. We're talking about your human life value. Let's be really direct here. For your family, you are a money-making machine. I want you to just take a second and think about the total amount of income you will earn from this day forward until the day you retire. Just ballpark it. It could be 2 cores, 5 cores, maybe even 10 cores. That number, that is your human life value. You are, without a shadow of a doubt, the single most valuable financial asset your family has. Now, what happens if that money machine suddenly breaks down? The entire cash flow that runs your home, the EMIs, the school fees, the groceries, it all just stops. Term insurance is simply the tool that insures that money machine. Let me put it another way. When you buy a car for, say, 10 lakh rupees, you don't even hesitate to buy car insurance, right? It's mandatory, sure, but it's also just logical. You're protecting a 10 lakh asset. So my question is, what about your income? Your human life value is a multi-crore asset. Why on earth would we religiously insure the 10 lakh car but leave the 5 crore money machine completely exposed? It doesn't make any sense. You don't buy car insurance secretly hoping you get into a crash so you can get your money back. You buy it for protection against a terrible, unforeseen event. We need to start applying that exact same simple logic to our own lives. All right, so let's say you're on board. Pure protection. It's the only way to go. But that leads to the next massive question. How much is enough? Is 50 lakhs enough? A crore? 2 crores? It feels like a guessing game. So let's get practical. We're moving from the why to the how, and I'm going to show you 2 really simple methods to calculate the exact amount of cover your family truly needs. For most people, this is honestly the fastest and most effective way to get to a really solid number. It's called the income replacement rule. All you do is take your current annual income and multiply it by 20. That's it. So if you earn 10 lakh rupees a year, you need 2 crores of cover. If you earn 20 lakhs a year, you need 4 crores. It is that simple. This is your starting point, your absolute minimum safety net. So why that specific number? Why 2 crores for a 10 lakh salary? Well, let's see how this actually works in the real world. In the worst case scenario, if you were to pass away, your family receives this 2 crore rupees and it's completely tax-free. They don't have to panic about where the next salary is coming from. They can just take this two core corpus and put it into something really safe, like a bank fixed deposit. Even at a super conservative 5 to 6% annual interest, that two cores will generate 10 to 12 lakh rupees of income for them every single year. It replaces your salary forever without them ever having to touch the original two cores. That right there is a real financial safety net. Now, if you want to be a bit more precise, there's the expense protection method. It's a simple 4-step process. First, you calculate all your family's future expenses. Then, you add up all your outstanding loans, home loan, car loan, everything. Next, you factor in those big future goals, like your kids' education. And finally, you subtract whatever assets you already have. It's a bit more work, but it gives you a number that is perfectly tailored to your life. Okay, so we know why we need it and we know how much we need, but just as important is knowing what not to do. It's heartbreaking, but so many people buy term insurance and then make these tiny, critical mistakes that can make the policy totally useless right when their family needs it the most. Let's walk through 4 of the biggest mistakes so you can avoid them. This one is huge. So many of us think, oh, my company gives me a 50 lakh cover, I'm all set. But that is such a dangerous way to think. Your employer's insurance is a perk, it's a benefit, not a guarantee. The second you leave that job or you get laid off or you retire, poof, that cover is gone. And think about this. What if you develop a health issue while you're employed? By the time you leave that job, you might be completely uninsurable, meaning you can't get a new policy at any price. A personal term plan is yours to keep. It belongs to you, not your job. You'll see this pushed all the time. Policies that cover you till age 99. And it sounds impressive, right? But honestly, for most people, it's just a waste of money. Just think back to the purpose of term insurance. It's to replace your income for your dependents. By the time you're 60 or 65, your kids will hopefully be settled, your loans will be paid off, and you'll have your own retirement savings. There's no income left to replace. Extending your policy to age 99 just jacks up your premium for years when you don't even need the cover. Just cover yourself until you plan to work, 60 or 65 is perfect, and invest the money you save. Okay, I need you to listen very carefully to this one. When you are filling out that application form, you have to be brutally, totally, 100% honest. Do you smoke? Do you drink? Does your family have a history of illness? You have to tell them everything. So many people try to hide a little something here or there to get a lower premium, but that is the #1 reason claims get rejected. I promise you, the insurance company will investigate every detail when a claim is made, and if they find you weren't truthful, they can, and they will, reject it, leaving your family with absolutely nothing. A slightly higher premium today is infinitely better than a rejected claim tomorrow. Now, this is an add-on, a rider, that I personally believe is a must-have. Just imagine this for a second. You have a terrible accident or illness, and it leaves you disabled, unable to work. Your income just stops. So, who's going to pay the term insurance premium? Well, this waiver of premium rider kicks in and says, don't worry, the insurance company waives all your future premiums, but your life cover continues, fully active. It's a tiny extra cost for a massive layer of security. It is literally the safety net for your safety net. Right. Let's bring all this theory to life. Let's see how these choices actually play out in the real world. I want to tell you a quick story, a tale of 2 families. It's a story that shows the huge, life-altering impact of making the right choice versus the wrong one when it comes to insurance. So let's meet Ravi and Sandeep. Both are 35, doing well in their careers. Ravi loves the idea of getting his money back, so he pays a hefty premium, 50,000 rupees a year, for a policy that gives him 10 lakhs of cover. He thinks he's being clever. Sandeep, on the other hand, understands pure protection. He pays just 15,000 rupees a year for a pure term plan with 2 crores of cover. Now, tragically, both of them pass away unexpectedly. Ravi's family gets the 10 lakhs. After all the immediate expenses, that money is gone in maybe 2 years. After that, they are in serious financial trouble. Now look at Sandeep's family. They get 2 crores. The first thing they do is pay off their 50 lakh home loan instantly. The remaining 1.5 crores goes into an FD, which generates 9 lakhs of income for them every single year. Sandeep's family grieves his loss, of course, but they don't have to worry about losing their home or their dignity. He left them a true legacy. Whew! We have covered a lot of ground here, haven't we? We've gone from the theory to the common mistakes to the real-life consequences. So now let's turn all this knowledge into a plan. Here is a simple, actionable checklist you can follow to get your family's future secured, and you can start today. Here are your 4 steps. It's that simple. Number 1, calculate your cover right now. Just use the 20 times income rule to get your number. 2, when you apply for the policy, declare every single health detail. Be an open book. 3, As soon as the policy is issued, tell your nominee, your spouse, your parents, where the physical or digital document is. A policy they can't find is worthless. And 4, this one is especially important if you own a business or have loans. Tick the box for the Married Women's Property Act, or MWP Act. This creates a legal shield around the claim money, ensuring it can only go to your wife and children. No creditor, no bank, nobody can touch it. It's a powerful fortress for your family. So if you forget everything else, just remember these 5 things. Let's recap. First, insurance is an expense for protection, not an investment for returns. Second, your bare minimum cover is 20 times your annual income. Third, you only need cover until you plan to retire, usually 60 or 65. Don't waste money until 99. Fourth, total honesty on your application is the only thing that guarantees your claim will be paid. And finally, for business owners especially, the MWP Act is an unbreakable shield for your family. I want to leave you with one final thought, a question that I want you to sit with and answer honestly. If, for whatever reason, you didn't make it home tonight, could your family pay next month's home loan EMI? Could they handle the school fees? Could they even buy groceries without your salary coming in? If the answer to that is no, or even a hesitant, "I'm not sure," then you know exactly what you need to do. Your family's financial security is your responsibility. It's the greatest legacy you can leave behind. For some more tools, including the Legacy Diary, just check out the link in the description. And if this was valuable for you, please subscribe, like it, and share it with someone you care about. Thank you for your time. Live rich and leave rich.